Well, the big story this morning, of course, is Bank of America posting its first profit in 3 quarters. However, it missed on the bottom line. For more, we're joined by the Bloomberg Best on Bank of America, Brian Charles. He's an analyst at RW Pressprich. Great to see you again, Brian.
Thanks, Betty. Good.
Okay, so with these results, you're getting a little bit more clarity. But really, the big question is, what are these legal costs, right, for Bank of America when it comes to these mortgage putbacks?
Right. When the company released its fourth quarter earnings, they did provide some clarity and sort of give a bound on what they thought the ultimate losses on the mortgage putbacks might be. They came in about $7 to $10 billion incrementally from the charges they had already taken. But what I saw this quarter in terms of like reps and warranties, loss provisions are, those pretty much came in where I expected them to be. Mm-hmm. But there were some incremental expenses related to litigation for mortgage-related litigation, but also assessments and waivers relating to foreclosure expenses. And that's something I'd like to get a little more clarity on in the conference call.
Because these costs will affect earnings, obviously, right. But do they affect the capital position of Bank of America? No,
fortunately, I don't think Bank of America's story right now is a capital story. I think they've got solid capitalization, and I think they will be able to maintain Basel-compliant Tier 1 common equity capital as those requirements come online. So right now, I'm really focusing more on the earnings story of Bank of America. Okay. And when all is said and done, when they get on the other side of this, I still think it's going to be a $45 to $47 billion pre-provision company, which means in a normalized loss environment, losses might only be about 10, 11, maybe $12 billion. Okay. So that's like a $35 billion pre-tax company. And after taxes, I still think it's about a $24 billion net earnings company. And with the current share count, that's about $2.40 a share. So
and that's why you have a speculative buy on it.
I do. Right now, I am concerned about the timing of the reps and warranties and other mortgage-related losses, but I do think the company can absorb these over time.
Okay.
I just think it might be a 2012 story.
Tell me what's the difference between speculative buy and just a buy on the stock then for you?
Speculative buy in this instance is a long-term buy, but subject to short-term trading volatility because of expenses that may pop up quarter to quarter.
Okay.
I think the company can
and in this case, it's legal
time.
Overhang. That's the volatility in the stock.
Well, that's the volatility in this quarter. We'll see the reps and warranties exposure, let's call it in subsequent quarters. But I think over time the company can absorb these. The only problem is when they come up with expenses that people may not have anticipated, the stock itself may be subject to short-term volatility.
Why do you think, though, that, because you just backtracking a little bit, you said that they're likely to comply with Basel III standards on capital. Right. What gives you that confidence?
Well, the company has done a good job of building its capital ever since the credit downturn in 2008. It's sold the assets that it's wanted to sell, non-core assets, have been able to reduce its risk-weighted assets while building its Tier 1 and total capital. So I'm pretty confident the company has the earnings power to continue doing that, and it still has some non-core assets that it can run off over time to reduce its risk-weighted assets.
But it wasn't enough, though, to get the Fed to approve a dividend increase.
Well, I guess I didn't expect the dividend to increase this year myself as of the fourth quarter earnings, but that was pretty much because we still have these reps and warranties exposure-related expenses in front of us. While I think the company can absorb them, right now we're not sure exactly what those will be, or at least the range of estimates that I and other analysts have come up with have been so wide you can almost drive a truck through them. But even on a worst-case scenario, my thesis was that the company could absorb those. Right. Except in the meantime, since we're not sure exactly what those will be, I imagine the Fed would be more comfortable seeing the bank absorb or adopt, I guess, a more defensive posture in terms of capital.
Then what do you read into Bank of America or Moynihan applying for that early, at least early in your view? What do you read into that?
Well, I guess he was enthusiastic, and I think knowing the books better than I do, certainly, I'm sure he was more confident they can absorb any kind of mortgage-related expenses over the next couple of years.
I mean, because the stock's been down, I think, like 32% in the past 12 months. I mean, it almost, is some sort of pass that he's making to try to turn the stock around, don't you think? I mean, he's grasping for something to turn the stock around.
Yeah, I think so. The company was doing great in terms of market perception last year, about a year ago now. But once these reps and warranties exposure-related matters started popping up, the stock pretty much deteriorated over the course of the summer last year. It bottomed out in November, and has recovered since then. Right. But they're still kind of muddling along, and I think what Brian Moynihan is trying to do is just exhibit some sort of confidence to the market that they can absorb these costs.
Do you have other questions on management, or are you pretty comfortable with what he has in place? I mean, I know he just named a new CFO.
Right, and that's right now. Yes, I'm confident. There's nothing that makes me concerned about the management team. I just know they have a number of challenges trying to turn the bank around.
Yeah.
But I think they're coming along.
Okay, all right, coming along. Maybe not an A+ there, but
well, they have a number of challenges.
Yes, challenges.
And so far, I think they are doing a good job.
Okay, Brian, thank you very much.
Thanks, Betty.
Really appreciate it. Brian Charles, he's a Bloomberg Best on Bank of America with RW Pressprich.